just from your experience in Japan, and now we have low interest rates in the United States, do you see a lot of parallels? I mean, are there things you learned in Japan that you applied to looking at U.S. markets?
Yeah, I mean, absolutely. Look, there's many differences, but there's also many similarities, right? So essentially what's happened in Japan over the last... look, the reason interest rates are zero in Japan now is because they haven't been able to grow their way out of stagnation, right? So demand has been... There was so much excess demand pulled forward by the bubble that there's just a huge amount of slack in the system, and no amount of stimulus has been able to shake the economy, in a fundamental way. There have been periods of, 18 to 24-month periods of growth, but in a very fundamental way, there's been no escape velocity for that economy, right? And part of that's demographic, let's be honest. So look, if I was to comp Japan to the US, right, I would say on the monetary side, it's looking increasingly like Japan. However, on the demographic side, it's completely different. So I don't want to push the comparison too far, right. But because of the extent of low interest rates and how they've devolved globally, honestly, actually, I think Europe is in a much, much worse position than the US, and it's a much better comp to Japan. So Europe is definitely worth making that direct comp. But anyway, going back to the US, I don't want to stretch the comparison too far, but from a monetary perspective, a lot of those Japanese mistakes have been made and are being made in the US, just because we've had easy money for so long. And there is this assumption in the market, particularly since Trump's come in and more recently, there is this kind of, buy the dip no matter what kind of mentality that the US president, the US leaders have kind of encouraged. And I guess Powell has obviously encouraged by backflipping at the end of last year on the plan to tighten, right, and kind of completely capitulating. So there is this mentality, I think, pervading the market that, stocks will just not be allowed to go down, which, the last time that happened was 2007. So, and by the way, I'm not massively bearish, and I'm not, net 50% short or anything like that, but right. It's the reason why I run my book, say, 20% net long, and beta adjusted close-ish to flat, because there will be a reckoning, right? As it's as clear as mud. Trees don't grow to the sky, and you have stock market corrections. That's been the case since stock markets were invented. Just because we've had 11 years of bull market doesn't mean it won't happen again. It just means all the people operating in markets these days weren't around the last time the market fell out of bed, or a lot of them.
Could you see a situation where we just go into this like low growth stagnation for another 10, 20 years with low interest rates?
I could. Maybe demographics pales the US out. I could definitely see it. And if that's the case, why the hell would you want to own stocks here, right? Because the Japanese analog then becomes much more relevant. If you look at Japanese stocks, look, not only have they done nothing in absolute terms since 1990, right? They're basically flat.
Yep.
But the valuations are just a fraction of where we are in the US, right? Yeah, the Topix trades at what? Around book, or a slight premium to book value, versus the US at what? Two and a half times book. The S&P, that is. And just in terms of average multiple, right? The S&P is at 18, 19 times earnings, and the Topix is at what? Low double digits, right? So, all these guys in the US who say, oh, we're just going to have low interest rates forever, therefore the weighted average cost of capital, cost of equity has to come down as the cost of debt structurally low. Well, no, cost of debt's been zero in Japan for 25 years, and those stocks are still cheap. So,
all right.
Which one? That isn't that an erroneous conclusion? So,
because Buffett, right? I mean, he has said if interest rates stay low for a while, then we'll look back and think stocks were really cheap today.
Look, I'm not one to tell Warren he's wrong, but
no, please.
I think that I think that maybe he has a more sophisticated way of coming to that conclusion. But to my mind, that's essentially saying the credit market is sending the right signal, right? I think we have to understand why interest rates are so low. Interest rates are so low because they're being artificially suppressed by central banks. They're not so low because, and obviously because growth is very low and a fundamental ability to grow is low.
Do you see the artificial suppression though stopping? Like what if they do it for 20 years?
Well, look, I guess there's two. You asked two questions. Do I see it stopping? Sure. I guess yes, okay. because you're going to have political, fiscal policy is going to change, right? Because rates have been so low for so long, and you've had this extended narrative of the wealthy getting wealthier and the haves getting more to have and the have-nots just getting more mired in the mud. It's leading to political change. Political change is highly likely to be inflationary, highly likely, no matter what happens. And inflationary conditions will change interest rates, right? Eventually. And when that happens, well, throw everything else out the window. We're much more likely to have stagflation than stagnation, I actually think. So, look, I own a little bit of gold.
Yep.
It's not my base case scenario, but I don't think we're going to muddle along in this kind of stagnation forever with stocks levitating forever environment. And I guess the other part of the equation. Sorry, just to finish that thought. The other part of the equation is corporate profits, right? So it's not just the discount rate; it's the absolute level of corporate profits are at all-time highs. Essentially, margins are at all-time highs, and the reason for that is corporations have way more power than ever before, right? So Jonathan Tepper's thesis, right, that the myth of capitalism, that you have far more concentration and oligopolism than people think, and that leading to corporations making more money and the little man getting screwed, the worker getting screwed. That plays into this as well. So I think we're much more likely to see a scenario where, globalization kind of has not run its course, but becomes more difficult, right? Trade wars, tariffs, etc. So things get more expensive. Wages have to go up to placate the people who've lost out the last 15 years. Then you also have this political imperative coming, which would be highly likely to be inflationary, running budget deficits, what have you. Add that all in a blender, it's very hard to see how rates stay this low forever.
Right.
Very hard.
Right.